geopolitical tensions in the Middle East, a horrible war going on. We're back with Jeff Hull from Manulife Securities. He's going to tell you how to build a portfolio using defense stocks. And Jeff, you've been involved in military affairs. You're involved in a couple of military groups. Tell us, what you sit on the NATO Association of Canada board, is it?
Yeah, that gives me a real good perch in which to see, especially Russia, Ukraine. That's helped me for my investors as an example. And actually, I've done some stuff in Israel as well, which is interesting. So again, first off, war, nobody wins at war. It's a sad scenario. Mm-hmm. But for investors, it's important. Just like a military has to have a battle plan, investors need to have a battle plan too, what to do with their portfolio. Right now, it's a regional conflict, Israel chasing down specific terrorists, trying to retrieve hostages for the global community. But the real reality is, what if Iran does get pulled into the fray, and then the U.S. may have to respond? Then you could have a greater conflict within the region. So investors really have to have a plan when to turn left, when to turn right, and that's what militaries do, and people need to do that for investments as well. And that's where defense contracting stocks might be a solution for them, or something to at least consider.
So the biggies are Lockheed by revenue, Lockheed Martin and RTX, and then Northrop Grumman. I'm not sure. Can you discuss individual stocks, Jeff?
Absolutely. Yep.
Any of those three meeting your criteria?
Well, Lockheed Martin is the 800-pound gorilla. They're physically the largest defense contractor in the world out there. Northrop is third, and second is formerly known as Raytheon Technologies, which is now RTX, when they merged in April 2020 with United Technologies, which does elevators and HVAC systems and stuff as well, which actually brings up a great point. When investors are considering the industry, one thing they got to look at is which defense contractors are more of a pure play if you want defense contractors, because many go beyond defense and are into consumer products and other things. For instance, GE, General Electric, has about 6% of their revenue is in defense, as an example, where if you look at something like Lockheed Martin, 96% of all of their revenues coming in has to do with defense. Raytheon Technologies used to be great because they did a lot of radar systems for consumers and whatnot, as well as militaries. They do a lot of missiles, like the Tomahawk missiles, as an example. But when they merge, now, for instance, they only have 59% of the revenue comes from actual military activities and defense. The rest is from consumer products and other things as well. And of course, Northrop is 89% involved with military regarding their earnings. So if someone wants a pure play, make sure it's a pure play. And if you're looking for something that maybe has more diversification, there are companies out there that have their toe in the water for defense, but aren't a dedicated defense company.
Is there a defense company that you favor right now? Do any stand out for you?
Well, Lockheed Martin does. Obviously, the F-35 fighter jet is a huge program. They're the champion of that. They make a lot of revenue from the F-35. And also, being the biggest out there, it also gives them a lot of opportunities. And they're also in aerospace. They're helping the Orion project and spacecraft with NASA, as an example. So they've got a little bit of diversification in there as well. But overall, people need to look at it and find what's right for them and what risk levels they're comfortable with. Because again, wars can change, and that's an important factor to consider out there.
Am I right in thinking that 46% of Boeing's revenue is defense?
Yeah, 46%, so about half. People assume it's just the jetliners that they fly around on, like Air Canada we talked about earlier. And meanwhile, they're heavily into defense. They do things like helicopters for the military and stuff as well. So fascinating company.
What about General Dynamics? I always think tanks. They make the M1 Abrams tank.
Yeah, and actually General Dynamics has a factory here in London, Ontario that makes the LAV, the light armored vehicles. Those are kind of the wheeled vehicles that look like little tanks on rubber wheels. Canada ships them all across the world for many different militaries and allies out there. But this brings up a great topic, actually, because there's two, I kind of put defense contractors into two buckets. There's consumables and then long-term. So a General Dynamics is more of a long-term company. If you order a tank or a light armored vehicle, you might get it in 3 years, as an example. It takes a while to build these things. Out there in other defense contracts, if you order a submarine, it can take 7 to 15 years to design and actually get it built. It's almost like if I order the iPhone, 15 years later you get it and they hand you the iPhone 1. Meanwhile, it's iPhone 15 now. But what's more interest to myself, because investors want impact now, is consumables. So the former Raytheon Technologies, before they joined United Technologies, selling the Tomahawk missiles. In President Trump's first term, or his only term, in the first month, he sent 59 Tomahawk missiles sailing into Syria, if you remember, to blow up an air base. They're $2 million each. That was well over $100 million of missiles gone. So consumable, whether it's ammunition or other things, are things that are gone. Once you use it, you can't reuse them again. And then people reorder and reorder and reorder constantly. Those are more interesting. It's almost like a toll gate that provides a consistent income coming into those defense contractors, rather than a contract that's lucrative but lasts 12 years waiting for a submarine or something else to be delivered, as an example.
I suppose we kind of we talk about tanks and artillery pieces, but it's really the logistics. That's where the real challenge is.
Actually, you bring up a great point. Actually, when I've always asked, I said, if I was ever asked to pick a general for a war, would I want the best tactician or a master of logistics? I said, easy. Master of logistics. People forget that as you move troops forward, you got to fuel them, feed them, rearm them, all along the way. And even Steve Jobs of Apple, when he passed, who did he turn the helm of Apple over to? Tim Cook, who was his logistics master. Very important. Logistics are more important than the rest, but absolutely. And these companies specialize in a lot of that. But for investors, they got to find the right company for them, work with their advisor, do the work, do the reading to make sure they're comfortable. Even if this industry is one to look at, buy the biggest and the best and forget the rest.
Well, twin forces of rising interest rates and a general reworking how we work when it comes to our office presence has acted as a downward force, especially when it comes to private real estate. But our next guest says headwinds facing the sector are fading. Let's bring in Carly Tripp, Global CIO and Head of Investments at Nuveen Real Estate, Nuveen, which has $1.1 trillion in assets under management. Carly, thank you so much for joining us. Before I get into your outlook, I wonder if we could just take stock of the distress and the damage that we have seen in your sector, call it over the last year or two.
Yeah, sure. Thanks for having me today. And, I think damage and distress may be a little overstated. In fact, we've seen some of the best financial performance that we've ever seen in areas like housing, healthcare related real estate, and industrial. And so the market fundamentals are really, really strong. Where the distress really comes in is very isolated to U.S. office in particular. And I wouldn't call it distress quite yet. Even in the U.S., where office usage is a mere 50% of what it was pre-pandemic, we are seeing limited amount of foreclosures. And over the next 5 years, while there is about $550 billion of office mortgages maturing, it's not enough to disrupt what is a $15 trillion market in the US. And there are bright spots even in office. So while the asset class overall has been challenged globally due to rising rates and the rate cycle and inflation and all of the fun things that all of our sister asset classes are also dealing with, there have been bright spots throughout the industry as well.
Well, I take your point that the reality might be disconnected from, some of these stocks in the public market that reflect what's going on are trading almost like it is end of days for this sector, for this space. So now I'd like to bring in your view on the relief that you could be seeing and the opportunities that are emerging.
Sure. I think with the rate cycle mostly behind us at this point globally, it's getting a little easier to pinpoint what returns should look like, what exit yields should look like, what the cost of debt long-term should look like. Our view is that long-term rates will be higher for longer. And so how do you invest within that? Again, you invest within sectors that have growth, macro thematics supporting them. Healthcare, an aging population is a global phenomenon. What's happening now is really unprecedented. In 2050, 25% of the global population will be 65 years or over. That's very, very supportive of investing in medical office. It's supportive of investing in senior housing. Also, if we talk about housing here in the U.S., there's still a shortage of about $3 million, sorry, not $3 million of homes, but 3 million homes. And while we are faced with increase in supply, we expect that to kind of shake out, equalize around 2025. And long term, we still believe there is a structural supportive. And again, real estate investing, thankfully, gratefully, we are not following a 24-hour news cycle. We get to look at long-term macro thematics supporting the space and how the built world is really going to look and how we exist inside of the built world in 5, 10, 15 years. So that's really where our focus is.
And how do you approach putting dollars to work? You could do so in the private market, purchasing or buying into physical properties. But I was at an investor conference a few weeks ago, and the point was made, look at some of these publicly traded REITs that are trading at discounts to their net asset value. You can buy access or exposure to public properties, private properties, I should say, in the public markets for 20, 30% off.
Yeah. Absolutely. And so I am a private real estate investor. However, we do manage diversified portfolios that have public exposure as well. And as an investment committee at Nuveen, we really cross collaborate amongst different asset classes. And so our view right now is that the public markets offer a lot of value in commercial real estate, particularly if you're investing alongside of an active manager. So if you look at some of the office REITs, as an example, in the US, they're trading where they were in the early 90s, really look like land value in our opinion. And again, when things start to get shaky, uncertain in the near term, and we're facing a business cycle, replacement cost analysis is really important. So are you buying below replacement costs, and where can you really kind of get in as an entry point today?
How out there do you feel in your thesis? Does it feel very contrarian, or are you starting to face competition for when you're trying to buy up some of these assets?
No, competition is still light. Access to debt is still light. So liquidity is still really thin in commercial real estate. But if you're a large balance sheet investor and you're not reliant on leverage, this is the time that you can really win. And where you can win is by advancing your strategic objectives, taking advantage of some inorganic growth opportunities. So we've had a couple M&A transactions over the last 12 months. And that becomes a really opportune time, because where there are capital gaps and capital needs, our balance sheet can fill them. That's just the benefit of being owned by a very large general account, which is one of the largest allocators in the world. So again, depends on your position in this market, but if you're big and sized and scaled and solvent, you can really kind of take advantage of it.
And do you do this through private equity exposure, or do you do it through private credit?
We invest in both. And so we have both private equity funds, and we are one of the largest lenders in the US. And so we take advantage of both. An emerging area of the market that we're starting to see to kind of fill some of the gap financing I'm referring to is preferred equity. And so many investors are looking at that slice of the capital stack that's offering current double-digit returns and limiting downside risk as really attractive today. So that is an emerging part of the market. Again, where there are gaps in financing, there's always opportunities for investors.
All right, Carly, fascinating perspective. We appreciate it. That's Carly Tripp joining us from Nuveen Real Estate.
Let's get a preview. Tom Porcelli joining us. He covers the U.S. economy with PGIM Fixed Income. And Tom, it's great to have you back with us. Let's set the stage for what to expect from the Fed today. What are your own expectations?
Yeah, so good to be with you as always. Look, I think it's easy to go in with an expectation that not much is going to happen at this meeting. Powell just spoke within the last week or two. Nothing has really changed all that much from a data perspective, especially as it relates to whether they would be surprised by a data point. I don't think there was any surprises as it relates to their expectations on that front. So I think this is one of those meetings where you probably see very little change in the statement. And his press conference, I think, sort of the same. Now, I know that makes for really boring TV, and I apologize about that. But that's the reality. I think we're very much in wait and see mode, and that's an idea that Powell really drove home during his last speech just a week and a half ago.
Well, let's dive into some of the data points as you see them. As a lot of people were setting the stage for today, they would point to the fact that there's been some improvements on inflation. That is encouraging for, let's say, Jay Powell and the Fed. But you are still seeing some resilience in certain parts of the U.S. economy. So would it surprise you if the takeaway is that the door is still open for another rate hike, even though, every new additional hike that we see, people get a little bit nervous about what it means for the broader economy?
It's a really important question that you're asking. And I think here's the right framing of it, right? If you need like a calculus around it, I think this is it. We're still really north of target from an inflation perspective. It's improving, as you rightly highlight, sort of month after month, and we think you'll continue to see improvement. But the longer you remain above target, particularly to the degree that we are above target now, the longer Powell and company will sort of latch on or continue to hang on to the idea of there could be more to come. I mean, I think they need that dangling out there from a market perspective. So I think you're quite right. I think the one thing that he will, I think, be definitive about is, they reserve the right to do more. They want to keep that door open, and he and others on the committee, I think they've done a really good job of that, of really trying to drive home that's part of their reaction function. If things don't improve or continue to improve in the way that we've seen, they could do more. So I think we'll hear that. But I think it's important to note at this point, I think that they're done. When you think back on that last speech that he gave, and again, so many other Fed officials right before him spoke about this, right, in the sort of the week leading up to his last speech, they all really drove home this idea that they've put a ton of tightening into the system, and now it's time to sit back and see how that. See how that shakes out. I'm a huge proponent of that as an idea. I mean, I think this is another way of thinking of this is prudence is winning the day, and I think that's the right approach at this juncture.
There's also the bond market story, Tom. It gets a little bit complicated, but I want to take our audience through it because it's been an important dynamic to watch, especially if you're watching the stock market. So you saw a lot of selling pressure on government bonds. That pushed up yields. People started talking about how you saw multi-year highs for Treasury yields. In the case of the 10-year, I think 16-year highs, and that gets people worried about borrowing costs going up. To a certain extent, maybe that does some of the Fed's work. One of the contributing factors, though, aside from what the fixed income folks were monitoring from the Fed, was the fact that the U.S. government has had to sell a lot of debt to deal with the deficit picture. And as we alluded to earlier in the broadcast, the view in the market today that maybe the U.S. government's going to be a little bit more sensitive to the pace of selling to try to get people from feeling too rattled and maybe putting more pressure on yields. That seemed to push yields down today. I set it up by saying it gets a little complicated, but how do you assess how the government all of a sudden and what they do with selling bonds to fund the economy factors into this complicated story?
Yeah, I think you framed it absolutely perfectly. And so what I would add to that is, I think what we have to keep in mind is, it came as sort of a relief today, to some extent, that the Treasury, did not issue as much as I think, some feared could potentially materialize today. The thing I would keep in mind, though, about that is, while they may not be inclined to continue to increase issuance at, sort of the next several quarterly refundings, the reality is this. Issuance is going to remain really elevated, right? Even if they're not increasing it, it's going to remain elevated because, you think about the deficit set up in the United States. There's deficits for as far as the eye can see, and I think while we have to recognize that in an environment where DC is sort of split down the middle, right? There is one thing that both sides of the aisle agree on, and that's defense spending. So we can easily see a scenario where in the coming quarters that there's more spending applied to defense, and that means that deficits remain elevated, and so too will issuance. And I think that's something that the market is going to have to come to grips with. So this idea of higher for longer, we think that is absolutely the right way of thinking about the backdrop. Even in a scenario where the Fed is cutting rates next year, a scenario that we think is certainly plausible. We don't, however, expect any meaningful cuts. So even if you get 50 to 75 basis points worth of cuts in the coming year, you're still going to have incredibly elevated rates. And sorry, this is a long answer, I apologize, but let me make this one last point because I think it's really important. If you think about the sectors that are really sort of interest rate sensitive, right? So you think about things like the industrial space. You heard some really interesting comments today in the ISM report that is really become pretty clear that those sectors, those interest rate sensitive industrial sectors, those manufacturing sectors that are most prone to seeing or being impacted by higher rates, they're starting to feel it now. That to me is not necessarily something that's encouraging, to say the least.
Okay, well, a lot to chew on there. Tom, we appreciate the breakdown as always. Tom Porcelli, Chief U.S. Economist at PGIM Fixed Income, joining us.
Well, Shopify beat sales and profit expectations in its latest quarter. The Canadian e-commerce platform saw sales jump by 25% compared to the same period last year, and its profit margins improved as it cut down on expenses. For more on Shopify's results, we're joined by Ken Wong. He's the managing director of software research with Oppenheimer. Thanks so much for making time for us this afternoon, Ken.
Oh, no problem. Thanks for having me on.
So I'm looking at your newest note right now on Shopify's results, and you're referring to the new Shopify here. And so can you describe to me what you think characterizes the new Shopify?
Look, I think what a lot of investors needed conviction in was that Shopify was not going to grow at any cost anymore. The hope was that this would be much more balanced, more profitable growth going forward. And even though they did cut costs pretty meaningfully in Q2, I think there was still some investors that were waiting for the true evidence. And I think this quarter demonstrated that in heading into Q4, typically a higher spend quarter, they're messaging that OpEx on a GAAP basis should actually trend down. I think that was the final piece of evidence necessary to get people to realize that this isn't the same old Shopify. Right, we're looking to potentially have high teens exit free cash flow margins for fiscal 23. Just 12 months ago, this was a money-losing business. So clearly, we're on the right trajectory from a profitability perspective.
In terms of those operating expenses, I was reading into the commentary from the conference call, and the company says that it has started hiring again, but doing it at a slower pace, and they're being pretty selective about it. But this does follow, some pretty significant job cuts in 2 rounds for Shopify. How do you see Shopify moving forward with this? If they are starting to do some hiring, do you think that still works? That still allows its operating expenses to be sustained at the sort of levels that you're looking for?
Oh, for sure. Look, I think the message was heard pretty loud and clear. The hiring will be very selective from a total headcount perspective. I'm assuming that headcount will be largely flattish going forward, with again maybe some hiring on the edges for their enterprise motions, maybe around AI, which obviously is a sort of a hot topic right now. But I don't expect this to be broad-based hiring. I think kind of one of the underlying messages that we came away with was, we didn't go through all the hard work to get to the margin profile that they're at today, only to reverse course. So my expectations are that the margin trajectory continues to trend upwards.
Yeah, that's interesting. On the AI front as well, that came up on the call too. And the president, Harley Finkelstein, speaking about how AI is for everyone and saying that its capabilities should be captured and embedded across the entirety of a business, pointing to Shopify's Shopify Magic suite of AI-enabled software. How significant is Shopify's offering there with Shopify Magic?
Look, I think all things AI at this stage is we're taking a to be determined type of an approach. But I think what we'll see from Shopify is what they've consistently done throughout the history of the business, which is you take high-end enterprise capabilities and try to democratize that across smaller merchants and to help improve the customer buying experience. From a revenue perspective, I don't see it as a direct needle mover, but I think it will help improve merchant onboarding, which should drive subscription. And I think indirectly, it'll help consumers, find things to buy a lot easier. So, that should drive conversion, help drive GMV, which is a large portion of the company's revenues.
The AI features at this point, they're just included, aren't they, Ken? Sort of free add-ons?
Correct, and that's largely consistent with most software vendors out there. I think in any situation where there's determined to be outsized value created for a merchant, I do see opportunities for them to potentially monetize on specific modules. But for now, it is baked into the platform.
Okay, so at some point they might be able to monetize that part of the platform. I'm curious about the volume of transactions that Shopify saw. It was an increase or a beat above Wall Street's expectations. And when you're thinking about the consumer right now, is that a bit surprising for you to hear that the transaction volumes were actually greater than analysts were expecting?
Yeah, that definitely was a source of surprise. I think most analysts were assuming perhaps high teens GMV growth. They reported in the low 20s, especially in this type of an environment. I think perhaps what was more surprising was as they messaged the Q4, it also met consensus expectations at high teens growth on a reported basis and low 20s on an organic basis, especially when I think right now you're seeing across the headlines, a softer consumer sentiment. I think investors largely worry about, what Black Friday, Cyber Monday, holiday sales could look like. So, having a 4Q revenue number that largely lines up with consensus expectations was, for me, pretty comforting given the macro backdrop.
So give us a sense what you're thinking for Shopify shares. We're looking at the TSX version. You've got the U.S. listed one on your note here in terms of your price target. But give us a sense of how much room you see or upside you see for Shopify shares.
So we have an $80 price target, so that that does point to additional close to 25-30% upside even from here. Our valuation framework is largely built on the fact that we believe that this will be a cash flow generating business going forward. We're assuming roughly $1.5 billion of cash flow in fiscal 25. And with a potential trajectory of 20% growth on that number, from a valuation perspective, we largely follow a DCF. We think that the business can grow high teens and generate mid-20s terminal margins, and that helps justify our $80 price target.
Okay, Ken, great to get your insights and your context on the quarter as well. Really appreciate it.
Thank you for having me.
That was Ken Wong, Managing Director of Software Research with Oppenheimer.
Well, Sam Bankman-Fried, of course, was convicted yesterday of a massive fraud that led to the collapse of the FTX exchange. He was found guilty of 7 counts of fraud and conspiracy after jurors in Manhattan deliberated for less than 5 hours. We're joined now by somebody who was in the courtroom when it happened, Bob Van Morris. He's with Bloomberg News. Bob, thanks a lot for joining us. There's a lot being said about the fact that the deliberations here did not even last 5 hours. What's your take on that?
Well, I do think that's meaningful. The trial took a month. Jurors were in here every day and listening to testimony. There was really a mountain of evidence against Sam Bankman-Fried, and he faced the testimony of 3 of his former inner circle, including Caroline Ellison, his ex-girlfriend, who he installed as the head of Alameda Research, the affiliated hedge fund that is, the prosecutor said, took billions of dollars and that was misused by Bankman-Fried and others at the company. So he had a very hard time when it came to the jury. They deliberated, as he said, less than 5 hours. That's pretty short for a trial of this complexity and this length. And it shows that they really just didn't buy his defense.
And that was my next question. What was the nature of his defense? What arguments did his legal team put forward?
He had a real tightrope to walk. As I said, he had people that knew him, that worked closely with him, a number of them testifying as prosecution witnesses. He had to get up on the stand and convince jurors that at the same time that he knew what was going on at these 2 companies that he ran, but that at the same time he didn't know about the fraud that was going on. So it was very difficult. He had a difficult time on cross-examination. And it really does look like the jury just wasn't buying.
Sentencing, the figure 20 years gets mentioned a lot. What might he be facing here? And I know you told my colleague John Ehrlichman that there's some speculation that some of what he had to say on the stand may not have been accurate. And if the judge who's responsible for sentencing takes that view, things could get worse for Sam Bankman-Fried.
Well, that's right. 20 years is the top sentence for a number of the counts that he faced. Now, theoretically, he faces 110 years in prison. He's not going to get anything like that. But he could get 20 years is something that some lawyers have said is possible. The judge is not going to have a lot of sympathy for him if the judge decides that Sam Bankman-Fried got up on the stand and lied to the jury. That's going to add to the time that he spends in prison. So, we'll see. The sentencing is in March, and that's going to be just as fascinating as this trial has been.
Appeal. Has Sam Bankman-Fried's legal team announced their intention to appeal?
I don't know if I've heard them say that. They were certainly disappointed in the verdict, but he's certain to appeal and to take his shot in the federal appeals court. So we'll see how that plays out. But he's going to be staying in prison while that happens.
Right, that was my next question. What would the timing of an appeal be versus the timing of sentencing and a presumed entry into prison by Sam Bankman-Fried?
Well, he's already in jail. The judge sent him to a federal lockup in Brooklyn when he found out that Sam Bankman-Fried was making statements to the public that were and trying to intimidate witnesses. So he's been locked up since August. He's likely to stay locked up until he's sentenced. And so an appeal could take something like a year, and he's probably going to be behind bars for that time.
Bob, thanks a lot for this on a story that's being watched, of course, by investors all around the world. Bob Van Voris is with Bloomberg News, and he was there yesterday when the decision of the jury was announced.